As expected, Spanish Premier Mariano Rajoy rolled out tougher austerity measures for their 2013 budget as part of Madrid's efforts to bring the country's debt under control and meet its deficit target. Not only that, but tomorrow we'll see another budget for the 2013 announcement, this time from France and the socialist PM François Hollande. Well, joining me on the line to examine all this in a bit more detail is Chief Economist at SpareBank 1 in Oslo, Elisabeth Holvik. Elisabeth, thanks very much for joining me today. Now, Spain's government has implemented tough austerity measures once again today as part of their budget for 2013, and to help meet their 3% deficit target. There's very little room for Premier Mariano Rajoy to manoeuvre now, is there?
Yeah, Spain is in a very difficult position, and further austerity risks pushing Spain into a deep recession. We don't really know how much the real estate market will fall from here. Demand is tumbling down. You had a credit squeeze in the Spanish economy, and there's also an underlying bank run on Spanish banks, where people move deposits from Spanish bank to other safer banks. So all in all, I think that there will be a tug of war between the Spanish government and the market, and we will see higher interest rates, finally pushing Spain to ask for a full bailout help.
Spain's economy is undoubtedly shrinking fast. Are we seeing, perhaps like Greece, the beginning of the end of the road for Spain in the EU? Or will future bailouts from, say, the ESF keep the country afloat?
I fear that there's been too much political intervention already, making it harder and harder to let Greece and Spain get out of the euro and out of the really difficult structural situation that the euro has caused. It looks like there's more political will to kick the can further down the road, to avoid taking losses up front. And that will, of course, prolong the crisis for the Spanish economy. And I fear we will see a long period in Spain with really low growth, high unemployment, difficulties in the banking sector, and as we talked about zombie banking in Japan, we could talk about zombie countries in Europe. So I think the best thing would be to take losses up front now and to release Greece, Spain, and probably some of the other countries from the common currency. But it looks like it's the political will is to kind of push the process of taking losses into the future.
Now, we've got France's budget for 2013 on Friday. What are the markets hoping to glean from the budget announcements going forward, do you think?
France is really in a slightly same position as Spain. You have a weak, deteriorating economy for many years. If you look at the current account balance to Germany, it has been sharply widened, the deficit with Germany, from about 5 billion euro in 2001 to 25 billion last year. If you look at the competitiveness measured as labor cost, it has increased by 19% of the last 10 years. So the underlying strength of the French economy is weak, and they need to implement more pro-business reforms to start to tackle the underlying growth in public expenditures, facing an aging population and already a large share of the working population employed in the public sector. I fear we will see only tax increases and spending freezes, not really tackling the underlying problem of the French economy. And if you look at the figures, in order to reach their target next year of a 3% deficit, they would need to cut about 30 billion euro. And that is with an assumption of an increase in GDP growth to 8.8% next year. And if you look at the leading indicators for the French economy, they are all pointing to weaker growth, which indicates that the French government would probably have to cut even more going forward. And with 3 million people unemployed, it's hard to see how they can turn around the economy over the next couple of years without going into structural reforms.
OK, that's all we've got time for now. Thanks very much for joining me, Elisabeth. For your latest updates and exclusive interviews, stay with us here on Dukascopy TV. But for now, goodbye.